If you're hunting for stocks the market seems to be ignoring, you're in the right place. At Insightful Value, we specialize in uncovering companies that still have real-world relevance but are trading at prices that make you stop and ask, why? Today's spotlight is on Robert Half, a name you've probably heard, but maybe haven't thought about as an investment. This review is for informational and educational purposes only. It is not financial advice. Robert Half is one of the biggest names in professional staffing. They help companies find talent in accounting, finance, legal, administrative, and technology roles. It's not just about temporary hires. Robert Half also runs a consulting division through Protiviti, offering risk, compliance, and internal audit services. Basically, they're in the business of people, and when businesses slow hiring, their revenue takes a hit. That's what we're seeing now. The stock price has been under pressure, dropping significantly from post-pandemic highs. Why? The economy is cooling, job growth is slowing, and companies are more cautious with hiring. Robert Half's revenue and earnings have declined over the past few quarters, with management openly acknowledging the softer demand in staffing. But here's where it gets interesting. This company has zero long-term debt. That kind of balance sheet strength is rare in this sector. Even during economic slowdowns, Robert Half stays profitable and keeps paying dividends. Speaking of dividends, this company has a strong record. Robert Half has increased its dividend every year for nearly 2 decades. In 2024, it raised the dividend again, and the current yield is attractive, especially when you consider the stock's lower price. The company also regularly repurchases shares, showing confidence in its own long-term outlook. Margins are healthy for a staffing firm, with operating margins typically in the mid-teens, though they've compressed slightly with the recent slowdown. Still, Robert Half runs a lean operation and has historically bounced back quickly once hiring demand picks up. From a value perspective, the stock looks cheap relative to its own history. Price to earnings and price to cash flow ratios are well below long-term averages. That doesn't mean it's an automatic buy, but it does suggest the market might be pricing in more fear than necessary. Now, the risks. If the job market stays weak or companies delay hiring for an extended period, revenue will stay under pressure. The staffing industry is also cyclical. Robert Half thrives in strong economies and slows down in weak ones. There's also the threat of automation and online hiring platforms gradually reducing the need for traditional staffing services. However, Robert Half's specialization in skilled roles, accounting, legal, tech, makes it harder to replace with a simple app. So, why consider it now? If you believe the job market is bottoming and hiring will slowly pick back up, Robert Half is positioned to benefit. You're getting a high-quality business with no long-term debt, consistent dividends, and a strong brand, but at a much lower price than 2 years ago. Why stay away? If you think the economic slowdown will drag on or worsen, Robert Half's earnings might take longer to recover, and the stock could stay stuck. At Insightful Value, we break down opportunities like this, companies with real cash flow, real products, and real upside that the market might be missing. No hype, no noise, just smart breakdowns. You can find more detailed analysis on Robert Half and other companies like it at insightfulvalue.com. Don't forget to like this video, subscribe to the channel, and head over to insightfulvalue.com for more sharp insights into undervalued companies.